So why have we done this webinar today? Well, what it's all about is that I'm an investor, okay? I have a pension, I have ISAs, and I, like you, have seen what's been going on in the markets lately, and it's not been very pretty, being honest. And we're getting a lot of questions as to, well, look, the markets are going down, I'm paying out this money, I'm invested, and I know it's a long-term plan, but at the moment I'm seeing rates at the bank and the building society here, which I can get 5%, 6% in some cases. Why shouldn't I just be putting money in there? And it's a perfectly valid question. And we're getting it so much, we wanted to put this on and bring a pool of resources and expertise here for you so you can hear from some different voices and not just necessarily your advisor or the Mail on Sunday, whatever you might be reading. We wanted to do something a little bit different and add value to you, our clients, as well. And there's also some people on here as well that aren't clients yet as well. So big welcome to you, but hopefully it'll give you a flavor as to what we can put on for you. We're here to help effectively. And if you have any questions, drop me in the Q&A, any comments at all, you can get in touch with us after as well. Also, this is being recorded as well. Another reason why no one's going to see you all. So we're going to be using different sound bites and that as we're going along here today later on, and we can look back at what works well, what didn't work well for us as a firm, and we want to get these better and better and better and start doing more of them for you as well. So let's get cracking. So why are we here? So at the Bank of England, interest rates have steadily gone up. I think it's 14 times now the interest rates have steadily crept up. Not so good news for people if you're like me that has a mortgage, but it is good news for those people that have been savers for so many years, where we've been used to the derisory rates of 0.001 if we were lucky. It was really hard to get a good rate of return, but we're now starting to see better interest rates out there. But also we've had a really strange economic backdrop with what's been going on out there in the world, from Brexit to Trump getting in to the Ukraine war, and now obviously we've got the other wars. It's just been a bit of a nightmare time. From an investor's point of view, it certainly hasn't been a period of calm. So what should we be doing as investors? How should we actually be thinking about our money, and what should we be doing about it now? What action should we be taking, if any at all? So that's what we want to cover with you today. So what we want to answer today is, why shouldn't you just cash in your investments and just put it all in cash? Why shouldn't you do that? We'll hopefully cover that off for you today. And we're going to take what we call a calm and considered look as to what we're doing with some expertise here. So we have three panelists with me today. And what I wanted to do was cover this from three different angles. First of all is looking at the markets generally and the economy, how that's all looking. The second thing was from an advice perspective. So the people that are looking at investing or are invested, what should you be doing? And then thirdly, how do we feel? From a behavioral point of view, is what we're feeling at the moment a normal way to feel? Is it abnormal? How does it actually play out in our heads and what we think about money generally? So I've got three experts with me. So first of all, looking at the markets and the economy, I have got Lindsay James. Now, Lindsay James, some of you may have seen or heard of her before. She's an investment strategist with Quilter Investors, and she joined Quilter as an investment director back in 2019. And has recently become an investment strategist. So she's responsible for all the external commentary that goes on within Quilter, looking at the market, speaking to advisors, and also the national press. So we thought there's nobody better to actually look at commenting on that, and spending most of her career as an equity analyst for a large blue chip fund manager as well, and then hedge funds. So the experience with Lindsay is vast. So we're calling on her to get an idea of the market. We've also got Paul Young. He's a director with a company called Your Financial Footprint. He's a really well-renowned business consultant. We've worked with him for some time, and a great character to actually work with as well. And they basically have a consultancy practice that understands how we work from a behavioral economics perspective. What is it we think, and how do we feel about money? And how does that impact how we feel on different aspects of our day-to-day life? And they've been featured on BBC, LBC radio, and in the Times newspaper. So again, a good quality person. And lastly, our other good quality person is our very own Craig Brady, who's been an advisor with us for many, many years. I'm just trying to think, actually, one of our senior advisors at Citrus Financial, and graduated with first-class honours in economics in 2009, and joined us actually in 2016. So got a wealth of knowledge and experience about talking to clients and about what the markets are doing, and has seen a fair bit of change during his time with his career as well. So I'm going to bring all three of these in to have a conversation with me. I'm acting also as the voice of you, the consumer. As I said at the beginning, I'm an investor too. I can log into my app. I see my pensions lost money. I see the funds that I'm in. And you naturally think, oh, should I be doing something different? Have I done the right thing? And you almost start to question how you're feeling and thinking about things. So first of all, I'm going to start with Lindsay. Can you give us, first of all, a bit of an economic update? And I'm assuming it's hard to to actually predict a lot of the impact of what's going on globally at the moment. But where do we actually stand right now, and how do you see things and what's playing out in your world at the moment, Lindsay?
Yeah, sure. Okay. Well, thank you very much for having me here today, first of all, and that very kind introduction as well. So the first point I really do want to make is that the economy is not the same thing as the financial market. The markets tend to move about 6 months before the economy. So that's really important at the moment because interest rates are one of the biggest drivers of markets right now. And of course, interest rates are going to start to fall well before economic growth accelerates. But the markets are forward looking, so they're going to be anticipating that and moving ahead of that. So markets will depend on interest rates primarily. Currently, they're expecting only really minimal cuts to interest rates next year. So that message of higher for longer that has come out from central banks, not only in the UK, but actually around the world, that has definitely been heard and priced in now by the market. That's what really lay behind a lot of the recent bond market weakness, because we had to go through that period of adjustment for expectations. Because the good news here is that the global economy has actually been holding up better than expected. And that's one of the reasons why the central banks have to say we've got to keep interest rates high to continue to fight inflation, because actually growth hasn't been coming down. And then the other two main drivers of markets are inflation and economic growth as well. So I'm going to talk about each of those in turn. Inflation is definitely coming down. So in the UK, it was 10% at the start of the year. It's now 6.7%. That recent oil price spike that we saw over the summer months really did slow the fall. We saw that decline sort of stutter a little bit. But I think that's just a blip, to be honest, because we've seen oil prices continuing to come down again in sort of more recent days. It looks like the conflict in Gaza will be contained. And at the same time, we're seeing the Chinese economy weakening. So that's pulling down oil prices. So, I think that's it. That does suggest that actually inflation in the UK is going to continue to sort of come down in months to come. And when we look at it elsewhere, we've got the Eurozone inflation back at 2.9%, the US at 3.7%. So it's really not the monster that it was. It's more of a sort of a gremlin now. I think the UK does stick out for having a bigger problem than anywhere else. That's down to a shortage of labour predominantly, but it's also because of our reliance on energy and food imports. And then economic growth is really the final part of the puzzle impacting market returns, even though, as I said, the market moves about 6 months, give or take, ahead of the economy. So when we look at the signs around growth, it's kind of a mixed picture, but there's some patterns forming. So firstly, the lagging indicators, which look backwards, generally look a lot better than the leading indicators, which make inference about future growth. I think at the headline level, that's really because the slowdown that was expected this year has probably been postponed a bit. The lagging indicators also show a global economy that was a lot more resilient than a lot of people were expecting, I think, because we've had a lot of pent-up savings from the pandemic, pent-up demand for hospitality and travel as well. Interest rate rises taking even longer than many expected to feed through. And so GDP growth has actually been pretty resilient this year. We've seen positive revisions of GDP growth in the UK. In the US, retail sales have been continually strong. And corporate profitability has been better than expected as well. When we look ahead, I think we do see some sort of clouds appearing on the horizon, though, if you like. We've got weakening consumer confidence trends. We see slightly weakening surveys from the business sector. But then again, it's a mix. We can see that the service sector is starting to dial back their expectations. But at the same time, actually, we've got perhaps the green shoots of recovery coming through from US manufacturing. So it's mixed rather than being, overly negative. And there are still some really positive tailwinds coming through that I think are going to be universal, regardless of what happens to the economy. And this is good news for the markets, because it's things like AI, which is driving investment in chips, for example, in the US, because they want to know for sure that they can compete in what's going to be really the pinnacle of digital growth, I think, for the next decade, if not longer. We've got, again, innovation coming through in the pharmaceutical sector, where the RNA vaccines that work so well in the pandemic are now being expanded for other treatments. We've got anti-obesity medications as well, which have been they've seen incredible uptake over the last 12 months. So there are still sort of secular tailwinds, if you like, that are going to continue regardless of sort of what happens to the overall economy. So there will be, winners as well as, areas of weakness in the 12 months ahead.
So you mentioned clouds, so there are a few things we've got to watch for, but overall you're feeling a bit more positive, perhaps. I'm getting that impression. Is that right?
So yes, I'm more positive on financial markets. Not
Okay.
so positive on the UK economy is definitely going to go through a weaker period, in the year ahead. But I think that what we are seeing now is that we're close to, probably at peak interest rates in the UK. I think we're very nearly at peak interest rates in the US. And that means that whilst we'll probably see an economic slowdown in the US, weakness in the UK and Europe, actually probably 6 to 8 months away, we've got interest rate cuts coming through. And what our data shows is that in the 12 months after interest rate cuts begin, then you tend to see pretty good returns coming through from equity markets and actually bond markets as well. So yes, I'm becoming a bit more optimistic about markets in the year ahead.
Good to hear. I think we need some good news, don't we, with all the news that's going on at the moment, especially. So just want to ask another question, if I can. When we hear things like markets going up, markets going down, and we see things like inflation, and we look at interest rates, when you see things, particularly with interest rates and inflation in the news, people often don't know how that impacts their investments that they've got with their pensions and ISAs and other accounts they've got. How do those sort of things interact? So why would somebody care if interest rates go down or up related to their investments in terms of versus cash?
Okay. Oh, that's a great question. Right. So, I mean, inflation is basically the bar that you want to be meeting over the long run in your investments, because that's the only way you're going to protect your purchasing power. So, what I would say, though, is as you get peaks coming through and spikes in inflation, it is very hard for financial assets to match that in the short term over sort of 12 months. But over the long term, then they really do. They are a much better way than putting your money into cash to protect against that. And we have plenty of data, that reflects that. We've got 100 years of data to look at how stocks do better than cash over rolling 5-year periods, rolling 10-year periods. Over 12 months, to be honest, it does vary. You can't invest with a 12-month time horizon, but the message is very much that financial assets are a better place to be than cash to protect against inflation, because of course inflation is impacting your financial objectives, which might be buying a property, having a mega holiday with a family, paying for a wedding. These are real money things. They're going to be moving up with inflation. When we think about interest rates, there's a couple of interplays here. Now, on the one hand, if you're a saver, it's good news when rates are higher. Now, of course, rates are higher at the moment, but they're not yet at the level of inflation. Inflation's at 6.7% and it's come down from 10%. So if you've been in cash, you've actually been seeing your purchasing power eroded over that period of time. The good news about inflation, interest rates coming down is for investors. So this is where interest rates actually form part of the maths, and I won't go into it, but that we use to value businesses. And that's because businesses have a stream of cash flows ahead of them as they deliver their goods and services to their customers, and people pay for those. And that's laid out in the future, if you like, a stream of cash flows. To value that business, we have to bring that future stream of cash flows back to today, and the prevailing interest rate at the time is an interplay into that equation. So as interest rates come down, so the valuation of that business mathematically increases, and that's why you tend to see markets rallying as interest rates fall. So it depends which side of the coin you're sitting on, if you like, for whether that's good news or bad news for you. But yeah, for investors, it's very much good news.
Excellent. Thank you very much. I have actually got a question that's come in. So please do keep your questions coming. I'm keeping an eye on the box if you see my eyes moving around. So we have got a question in from Paul, and I'm going to bring this in. Some of these questions I'm going to bring at the end, but this one seems to sit quite well with where you're at the moment, Lindsay, which is the quote was quite a rosy picture being painted by Lindsay. What happened to the recession?
Oh, right. Okay. So no, we still see a recession in the UK. And I think that's going to be very, very hard to avoid. And that's because there's such a lagged effect from interest rates. So we know that 40% of properties are mortgaged, around 30% of those mortgages have to renew in the next 2 years. The effective interest rate on the whole of the mortgage market is currently around 3.1%, but to get a new mortgage, you'll be paying about 5.5%. So we've got a lagged effect coming through, and that's not only in mortgages, it's in business loans, it's in other consumer loans. So there is certainly a headwind here, and we're feeling it, to be honest. Maybe it's going to be similar to Europe, but much worse than the US. Now, the US is in a different position. They are still seeing GDP growth this year of 2%. It's expected to be around 1.5% next year. And what I think is quite interesting is that corporate earnings growth is forecast to be around 11% in the US next year. Now, you'd think, well, why is that so different to GDP growth? And that's because the market has more representation from the goods sector than the services sector. Now, the goods sector has kind of been through a recession already. That's happened in the last 12 to 18 months because we've pulled forward demand for goods into the pandemic years. And then in the subsequent period, there's been a dearth of spending on like iPads, bikes, and all those sorts of things. That's now starting to recover a little bit. So the market is expecting earnings growth to come through to that tune of 11% next year. So we may well see an economic slowdown in the US. Perhaps, it's 2% this year, perhaps 1.5% GDP next year. That's a slowdown. We don't necessarily see a recession there, though. It's been a very resilient economy with considerable pent-up savings still supporting spending in the US. We've seen wage growth in excess of inflation. That's also supported spending. They've got unemployment of only 3.9% there. So, and as I said at the beginning, it's not about the economy, it's about the market. And the market is starting to see that there'll be rate cuts coming through next year and starting to get a little bit more positive in its outlook over that period. But I would say that sort of a 12 to 18 month period, there could well be a bit more volatility over the next 6 months as we just really start to understand how deep the recession will be in the UK and what the scale of the slowdown will be in the US. And that's still calibrating a little bit.
Excellent. Thank you very much, Lindsay. I'm going to come across to Craig now. Craig, our senior financial planner here at Citrus. So, Craig, what are you seeing from your clients' point of view? What are they talking to you about at the moment? What's on their minds? And what are you telling them and advising them to do right now?
Yeah, David, I think for most clients, they have the same concerns, which we've kind of covered with Lindsay in terms of, okay, well, this is what I can get out of the bank, and this is how my investments are doing. Should I be concerned? Should I not? And the answer is obviously it all depends on the individual circumstances, their goals, their objectives, their timeframes. And although what Lindsay's gone through really interesting, it is all short-term thoughts, short-term views on markets, and we spend our days talking to clients about those short terms because it's interesting, it's relevant. Paul will probably come onto the psychology of why people have short-term views, but really all us advisors know for sure is that over the long term, investments outperform cash. I think we've got a graph to illustrate that. So as you can see here on the graph, just talk you through how this looks. So let's go back to 1926, and you'll see all the different scales at the bottom. So you can see that although interest rates have got attractive in kind of recent, if you're looking back in recent years, since the 1920s, the average interest rate has been 5%. So they're only just getting back to they're just so historically low. I think a lot of clients have seen interest rates because they've been so low, and now suddenly they're appealing. Historically, they're probably slightly higher than average, but averaging out about 5% over that time period. When you go through all the different asset classes and you go up to say a balanced portfolio, you'll see that the average return over the long term, 10%. Now you can imagine kind of the long term compounded effect of that. And what you'll see kind of in the graph is, it's not a straightforward line to get there. There will be ups and downs. We will have recessions. We will have negative year for markets. And obviously, at the moment, in the forefront of a lot of clients' minds are, well, we've kind of had bad year last year, pretty flat this year, maybe slightly negative. We had a bad year in 2018. So you've had following 2008, you kind of had 10 kind of nice, calm, straightforward years for markets. Whereas kind of in the last 5, we've had a couple of wobbles. So it's just to remind clients about the importance of, you're investing for the long term. If anyone comes to me, I want to make 10% next year, they're not the type of client we're looking for. Ours are all long-term investments. Obviously, people's timeframes do change with time. It's important that you stay in touch with clients. You frequently review, what they're looking to achieve, their goals and objectives, their attitude to risk. The last thing you want is an anxious client. Again, Paul will probably come on to that, contacting you every week saying, my fund's gone up 1%, it's gone down 3%. It really is sticking to the plan. And unless, any of that has changed, then the advice would be, to remain invested. And then it's our job to worry about, okay, well, what's actually going on with the fund and how's that performing?
And it's interesting, isn't it? It's I think as an advice firm, and I've been doing this now for 29 years last month, crikey. And it has been you see a lot of upward curve. And we were talking, if you say off air before this, we don't get clients when things go up, people don't ring. It's when things go down, they do, because they're more nervous.
That's a natural, reaction. That when things appear to be going wrong, and no one likes losing money. When you see your money going down, and with an app so easy to log in, see it going, you feel like you have to do something. Whereas when it's going up, you don't feel like, okay, well, now's the time to encash because I've made, a couple of percent. You feel the urge, okay, I need to step in, I need help, I need to do something, I need to stop this, downward spiral. And it goes back to the old saying, timing markets rather than market timing. We can sit there and speculate about what's going to happen, in the short term, next 6 months, 9 months, when, we've been speculating about this recession now for nearly 2 years, probably, about the recession coming, still not here. And it makes for interesting chats with clients, but we can just stick to what we know, and that's, investing for the long term will provide you with returns.
And also, let's not forget as well, what's changed in my 29 years now is the facility to actually get more information quicker and more easy than you ever have before. So, years ago, there weren't apps on your phone that you could log in and see what your investments were. You had to ring up your advisor or go into the bank or wherever it was that you had your money. And it's just one of those things where I think now we can get more information. Sometimes too much information can be a bad thing potentially as well. So
and I
thank
think
you,
Craig,
Craig.
from a psychological point of view, in terms of, the amount of mental health issues now in the world, because people have more information to digest.
Yeah, absolutely. Paul, I'm going to bring you in now, our behavioural economist. So you've heard the conversation I've had with Lindsay and with Craig, and you're obviously involved in the advice world. So what's your sort of take on this? How are you finding things? What are we feeling? And are we right to be feeling that? So give us some background.
Yeah, sure. I mean, yeah, absolutely. I'm allegedly, I'm a human too, David. So I feel these things, So look, it's perfectly natural for us to feel around cash and questioning where things are. And it goes down to something very primordial. Greg talks about it. If the world around us, whether it's the tribe, the small environment, whether it's, a large environment or a modern environment, if everything's framed in terms of gains and excitement, we become far more risk seeking. If the world around us is framed in terms of losses or worry, then we naturally become risk avoiders. And a classic example is, you being in your little tribe years ago and you hear that there's a new food source across the stream and the river, and someone comes back with fruit, you think, this is amazing. And then the next 2 days, someone gets bitten by a snake. Oh, hang on a minute, there's a natural resistance to even going to that lovely prize. And also we can't help but value things that are very clear and present to us. Things like cash, and I won't go into what actually is money, because that's a bit too philosophical, I guess. But even the £10 note says "pair the bearer of." What does that mean? It is a token. So we have naturally, it's only natural to feel when the world's going to hell in a handcart. You've got Ukraine, you've got Gaza, all of this sort of stuff. To naturally feel about, okay, risk avoidance. Risk avoidance means, and if you think about it, one of the definitions of many definitions of risk, it's about lack of uncertainty. The more certain we are about life, the more happy we are about our decision making. And with uncertainty comes risk. And of course, things that the shorter time scale, hopefully we'll be finishing at a certain time and everyone can be relieved. You know you can go through a little bit of pain because there's an end goal. But at the moment, we don't know where that is. Now, what is that about? That's because of our obsession to the here and now. And the classic behavioral piece to get this into so it's totally natural to think, why don't I just bang it onto cash? Why don't I just put it underneath the bed and all that sort of stuff? And it's the classic behavioral tease, which is, and I'll ask the audience, is the rhetorical question, is if I'll give you £100 tomorrow, or I'm going to give you £110 in a month's time, which one would you rather? And it may be because you don't think I'm good for it, but most people, when we've done the experiments, over 80 to 90% say, give me the £100 tomorrow. Now, what's that about? Because you've just turned down effectively a 10% return in 1 month. So Lindsay will probably work out what the compound rate is of that, which is massive. But we're naturally more, I'd rather have the 100 quid in my hand, because we value it. It's that primordial thing of, if we've made a kill, I've got it in my hand, and I see another potential kill, I don't want to go for that one because I might lose this one and go back empty-handed to the tribe. So we value what's in front of us far more. And timescales are really important. So timescales are massively important about how you frame value and how you frame decisions. And that's about that timescale to invest. So Craig's perfectly right. What I'd ask for us to defend against is try and think about purpose. Okay, so we all heard about goals and financial planning goals, and it's a very American term, and hopefully you'll take this the right way, David, because you do a lot of goal-based financial planning, and it's really good stuff, I know. But goals, if we say, ask a client about what your goals are, most of us in Britain, only 4% of us have a goal written down anyway. Most of us feel sort of embarrassed that we don't have a goal. But I can what we all can say what our purpose is. We can all say, what is the purpose of me being here? What do I provide for? Who do I provide for? And reminding ourselves of the purpose for us investing. We're not savers. Well, actually, you ask yourself, are you a saver? Are you an investor or a trader? I don't think we're traders, but savers is short term. But are we investing? And remember, what's the purpose? What's the time scale until we want to enjoy it? And if you can start asking yourself the questions, and I'll go into other stuff later, I hope, is think about the time scale until you want to enjoy it. The time scale until when you're going to spend it, when you're going to pass it on, when you're going to enjoy it, when you're going to manifest it, when you're going to release that or transfer that pound into some other stock or value or car or asset. If you remind yourself about the time scale until you want to enjoy it, then that's cool. And by the way, being in cash is a good thing. The question I always have, though, is most people naturally, there's too many people who naturally have too much in cash because of the biases we have around us. There's very few, I'm sure if Craig agrees with me, very few people we have to convince to have an emergency fund. It's all about the future. So that uncertainty thing, think about the timescales. It's only natural to feel as we are.
It is, but then at the same time, well, I'm just sticking up for the client's point of view here. When you see something that goes down in value and you're consistently seeing something that goes down in value, it's okay to be scared though, isn't it?
Oh, absolutely. Yeah, absolutely. Well, it is, as long as you can remind yourself of the emotional curve of investing, which is when things are going well, we are naturally excited and we always think, why didn't I put more in at the beginning? And then when things are going to hell in a handcart, we want to bail out and hold and get out of it. So as long as we remind ourselves about that, it's natural, it's good. However, if you have a good framing conversation with someone like a business coach, a financial advisor, where can you find one of those at these times of day, David? But if you had a good planner who said, look, when are you going to spend it? Dan Arrowley was one of the world's leading behavioral economists. And what he really always wanted to say was people should invest and put their stuff in a drawer and never look at it again until the time they want to enjoy it. And they'd have a far easier and happier ride in life. But life's not like that, as Craig said. We have apps, winking at us daily. We have constant news bombardment. So it's natural to feel scared. But actually, in the same way, we need to go through emotional curve of change. Anger, denial, frustration, scared, and then out the other side. Yeah, my actual issue is we fear more the current about the markets are dropping, and my worry is actually because we can't see into the future. Is when we get in 10 years' time, the regret of not doing what we should have done 10 years ago. And that's where most people that I talk to when they get to end of retirement, because bear in mind, my other half's an advisor as well, so I have to eat, sleep and breathe this stuff every day, David, as you know, is that when people actually get to retirement, it's normally not a conversation about, oh dear, it's more a conversation about, oh dear, I wish I'd done more earlier. And that's the thing we've got to try and remember.
So do you think it's about also holding our nerve as well, when our instinct is maybe to think, oh, let's go into cash? And I'm thinking, as you were talking there, what happened when the pandemic started and the markets dropped like a stone, and we were telling people, stay invested, stay invested, stay invested. If we'd have told people to get out, and I had an advisor friend of mine who moved a lot of his clients into cash when the markets went down, who were really pleased that they told him to do that, that he was saying, move it into cash. So thank goodness you've done that. The problem was he then got a bucket load of complaints afterwards, because when the markets went up, they weren't in them.
Yeah.
But it's trying to predict the markets is really, really difficult. But it's, I don't know what you got to say to that, Paul, but it's hard, isn't it?
It really is hard. It is really hard. And I guess there's a couple of strategies as humans we need to think about. There's a thing called mental accounting. And for those of us who have a certain age can remember piggy banks. Remember those things, those little physical things you used to put money into? And some people put labels on, this is for weekly, this is for Christmas, this is our Christmas club. Why did those things work? Well, of course, because you've got little pots, little brackets, you're positioning what things are for. Now, little strategies we can start thinking about is, what's our money for? And one of the strategies we got to think about with cash is, how much do we need in the short term? What's my piggy bank for the short term, my emergency fund? What if things go wrong in the short term? What's my known short-term exposure to, I need to get some money out for, I don't know, a wedding or whatever coming up in the next 12 short-term months. But if you can work out what that is, and that that's safe, you've got a coping strategy which says there's absolute. So first line is absolute mandatory. We need this. Next line is discretionary. Above that is the sort of the happy stuff. That happy stuff is the bit that we need to take a longer term view on. Now, that's the stuff that I worry that when we get to. So what's the strategy around it? Try and think about those three buckets. What's your necessary, what's the short-term plan, and what's the surplus? And for some of us, it might be you need to put more into cash, David. Actually, it might be that there is that. And that's cool. And that's the way it is. But for the majority of humans in the UK, we are naturally more biased to put more in here than we think. We all think we're going to need more than we do in the next 12 months. Even with pandemic, even with financial crisis in 2008, you're rightly saying about, so think about that extra piece, and then that's a different timescale, and then you're an investor. Now, the thing that I worry about is it's not just about time out of the market, and I'm not an investment specialist. That's Craig and Lindsay, especially Craig. It's getting back into the market. And by the way, I have no axe to grind here. I'm not an investment expert, but my concern is that my mum is 92. And we had a conversation and she asked me about what I was doing. And I mentioned about this to her because she likes this sort of stuff. She said, oh, do you think it's a good time to get into the market? Mum, even if you wanted to, it's going to take you 30 days for it to be invested anyway. So it's too late. And actually, why don't you just give it to the grandkids? Because we don't need it, because there's a human dynamic to it. But the point is, even if you wanted to go today and press the button, you've missed it. There's no big alarm bell that gets signals saying everybody pile in the market. By the time it's happened, you've missed it. So if you can think about the three buckets, I don't know, you know better strategy than I, David. You're far better, and Craig, far better explaining this stuff. From a behavioural point, that mental bracketing, the mental accounting of little buckets, then I think you can be far more comfortable. This is safe and that's fine, but this is for the longer term. Brilliant.
Thank you very much. We've got a load of questions that have come in. So I'm mindful of time. I'm really respectful to make sure we finish dead on, to be respectful for everyone's time here. Question for you, Craig. And this is back of your quote, was asked. It said, Craig said, it's our job to see what can be done, paraphrasing, when clients are worried. What can Citrus / Quilter do, and what do they do?
Yeah, I think a lot of time, it's educating clients and kind of coaching them through what is happening, why it's happening, should they be concerned, what we see happening in kind of, the short term, but then what to expect over the long term. So, Paul's touched on the mental accounting, kind of the buckets. It's funny sitting with clients and being in client meetings, that's the way a lot of clients work. When you're trying to, Paul touched on, okay, well, goals is quite Americanism. Sit there, first time I meet a client, say, what are your goals? They look at me completely blankly, most people. So you really have to say, okay, well, what are you doing this for? What are you looking to achieve? Is it retirement, at 60? Is it, you just want to double this money over a period of time? People will have different objectives, and it's trying to frame, okay, well, why are you doing this? Why did you do it in the first place for an existing client? Where did you see this going? And it's just being there, it's, like I say, educating clients, giving them updates. you know, with the kind of the managed portfolio funds we use, it's making sure, you know, even in good years, you know, we touched on off there, when clients' money goes up 10%, you don't get a stream of people contacting you saying, you know, really good, I'm really pleased with how it's all going because it's gone up 10%. You know, that fund in itself could have done a bad job, even though it went up 10%, you know, because it will have comparators, it will have, you know, competitors. Yet when a fund goes down, it's instantly, you know, oh, that fund manager's done a bad job, or you know, something could have been done better. So it's just trying to guide clients through that and showing, you know, your fund might have gone down, but it's done a good job, you know, when you compare it to other funds out there. Or your fund hasn't done a good job, and these are the other options on the table, and these are things we should be considering doing. So yeah.
Can I just jump in on what Quilter have actually been doing as well around that?
Yes, well, bizarrely, I was actually going to go straight to you, but you beat me to it. So yes, please, Lindsay.
Great. So I chair our tactical asset allocation committee, which meets once a month, and this is where the portfolio managers get together and they discuss the outlook for markets, and they make changes to the portfolio. So what we've seen in recent weeks is that the portfolio managers have been positioning the portfolios pretty defensively. You know, for example, in the Carillion Active range, they've been putting in derivatives which protect against broad market drops without having to change the underlying funds that sit within that portfolio. Within Wealth Select, there's been additions to government bonds, which work very well when markets are falling in normal environments. You know, I know that hasn't been the case in the last 2 years. We've had some pretty unusual sort of times that we've lived through, but through a recessionary environment where interest rates are coming down, you would expect that government bonds would be more resilient this time around. So we've been adding to government bonds. In Wealth Select, they've also been moving to more large cap representation within the UK portion of the portfolio, away from some of the smaller mid caps, which could struggle more as you know, as we potentially go into a recession in the UK. So there are moves to position the portfolios for a bit of volatility in the next 6 months. But I think we see this time around that with bond markets now willing to or able to offer better returns, better insulation to volatility in equity markets, this means that for multi-asset portfolios, they are positioned more positively for the year ahead.
And there's a lot of diligence that goes into the funds that we as advisors are actually recommending to our clients in the first place, isn't there, Lindsay?
Yeah, that's right. So, you know, QFP, Quilter Financial Planning, designed the matrix by looking at the entire universe of funds available. They have numerous researchers. They use external third-party research as well from Square Mile to distill and look at a huge number of funds before they get anywhere near the matrix. And even when they are considered suitable for the matrix, they are still followed and updated and researched on an ongoing basis. So, you know, the idea is that this takes the onus off advisors having to do that themselves, where of course there would then be a lot of risk of some, you know, substandard funds going into clients' portfolios. By trusting QFP to do this part of the role for advisors, you're getting efficiency and scale and the ability of, you know, a dedicated team creating a suitable list of investments for you to use.
Excellent. Thank you, Lindsay. A couple of questions that have still come in. Lindsay, there's the couple for you actually here. Somebody's asked, do you think that the US election will cause more bumps?
Yes, this is going to be something I know I'm going to be talking about loads in the next 12 months. So I'm starting to read more and more about this. But yes, I do. So what I think is going to be different this time around is that, you know, I mean, Trump's ahead in the polls, so we have to take it seriously that he could get back in. We'll be following the indictments against him over the next 12 months, which might prevent him standing. But it looks like, you know, from what I read, that's going to be too slow to actually be effective. So if we assumed he got back in, then I think the market would be a bit concerned about how he could kind of potentially further damage international relations, not only with China, but, you know, what would happen with support for Ukraine, for example. I think, you know, he is talking about getting rid of the huge number of civil servants in the US as well, and replacing them with people that effectively answer to him. So, you know, there's a question mark that over, well, would it slowly turn from a democracy to an autocracy? And that would reduce the multiple that investors would want to pay for US equities in that environment. But we're a long way from that. You know, we are there is still, I think we've seen in the last few days, Biden has been seeing what good support through elections at Ohio, and there were a couple of other ones where abortion rights actually really supported the vote for Democrats. So, although Trump's ahead in the polls, it's only like fractionally, and we're way out for it to be a realistic steer on the actual outcome. So, I think that there's hope that over the next 12 months, actually some of these issues will potentially change those polls in the other direction, but we'll be watching it quite carefully because it could see a bit of volatility in US equities.
Which leads me on to my next question, actually, from somebody else that said, are my investments more impacted by the UK or US performance?
Yeah, it's US all the time. So, and that's why we talk about it. And I know sometimes we do webinars where we barely talk about the UK equities at all because they are a relatively small part of portfolios within our multi-asset range. Now, and I think, the US is by far the largest part because in global funds as well, the US would make up about 60% of the weighting. So, and where the US follows, so the UK and Europe leads with rate policy as well. So, it's still the engine of the global economy and our main focus. And where you're invested in the UK market, remember as well that the FTSE 100 has about 70% of its earnings coming from abroad. So again, that's not really representative of the UK itself. And that's actually why, we are a bit more optimistic about returns potentially from the FTSE 100 than we would be from the UK economy. So, they're completely different beasts, and just important to remember that as well.
Thank you. Question for you, Craig. Is it worth taking some funds out now to get a fixed rate for, say, a year and then go back into the market once the fix has come to an end?
Can I have your crystal ball, please, David? Yeah, we just don't know. That's the honest answer. We don't know. If we play this back in a year's time, do I think you'd be better off investing? Like I say, we just don't know. We just can't predict. All we can say with any certainty is, over the long term, investments, will far outperform cash rates.
There's the danger there as well, though, if you actually come out of the market and then it's gone up. But what we tend to find is that people see things that have happened and then think, oh, it's a good time to, by the fact that it's been a good time to be in, you've missed the good time to have been in.
Yeah, I think take last week.
So there's a bit of that as well.
I think take last week, for example, we've kind of had a poor 3 months for funds and for markets in general. And last week, markets rallied. And, I had a look before today, just gone through a few funds we have, different risk profiles. And you're looking at anywhere between, just last week, funds went up on our, matrix, anywhere between 1% to 4% in that week.
Yeah.
Sorry,
Lindsay.
Can I just jump in with some data? Because I think this is really, it's so powerful. After the first rate cut in the 90s, the MSCI UK did 45% in the year after. In 76, when rates started to fall, the MSCI UK index did 96%. So, these are quite individual, unique times with global events around them. We're not predicting returns like that, to be clear, but that rally comes when the headlines in the paper will still be about economic doom and gloom. You wouldn't know walking down a high street with boarded up shops and newspapers and recession and high unemployment that markets are about to rally, because the rally comes, straight after we've had peak gloom. So that's sort of the definition of the market low, when people are most pessimistic. Then you get the rally after that, but you wouldn't know it if you were just to read the papers. So yeah.
Thank you. And Paul, I'm just mindful of time. 12 now. Paul, do you want to just close off?
No, just the answer to me on that, should I take the money at a fixed rate? Yes, if you're looking to take the money next year. Because it's all about timescales. When are you going to enjoy it? If it's still the investment strategy was to enjoy it in 10 years, then my concern is you will miss out on a better return at the end of the 10 years. Now, all the stats and all the evidence talk about staying invested for the best 10 days. If it's I want to take the money out and enjoy it in a year's time, great. Otherwise, we have a big thing called loss aversion, loss motivation. The fear of losing is far bigger. And if only I had a crystal ball and could stand our clients in 10 years' time and say, this is what you've missed out on by coming out of cash for that 1 year, that's the biggest issue. And the other thing, which is the real elephant in the room, is I wish it was like 2 or 3 years ago when we had low interest rates at, say, 2% of the bank, because inflation was just about 2%, it was about par. Now, even with 4 or 5% of the bank, inflation is killing real return. It's the worst real return, Lindsay's probably got some stats, in decades. the worst real return in my money. And because we don't think about inflation until we go and pay at the checkout, and we don't even feel cash anymore, it's on a card, we don't feel the pain of it. So inflation is a really interesting thing, is that, and what's your real inflation? How many 55-inch TVs are you buying every year that the inflation rates are set on? What is your personal inflation rate? And I bet you, because I've done some examples, looking at some of the websites you can go online, most personal people in their latter life stages, their personal inflation rate is a lot higher than the 6.7%, because they spend it on things like heating and food and having fun.
I think it's called grey inflation, isn't it?
There
And I'm the grey-haired guy.
What are you trying to say? What are you trying to say,
mate? Excellent. Well, thank you ever so much, Lindsay, Craig, and Paul, and for all the attendees that we have here. We've got a lot of numbers on here. We will send you out a recording of this if you weren't able to attend, if you know anybody else that would like to. And also, we'd like to hear from you as to what you'd like us to cover and talk about during these webinars as well. But thank you all for your company. Much appreciated. And I hope you found that as helpful as I certainly did. But yeah, Craig, Lindsay, and Paul, and Simon, who's working this all behind the scenes, a big thank you. And we look forward to speaking to you all again soon. Thank you very much.